You think you know the $10,000 rule. Stay under $9,999 in cash. Don't show ID. Don't trigger anything. That's the story everyone in the metals world has passed around for years. But as of 2026, that story doesn't just fail you. It paints a target on your back. Picture this. You walk into your usual local coin shop. Same guy behind the counter, same cases, same back room. You've been careful. You never spend more than $4,000 at a time. You always use cash. You tell yourself, I'm invisible, I'm under the limit. But this time, the shop owner looks different. He's polite. He's nervous. You say, I'm here to pick up another $3,500 in silver, same as always. He sighs and pulls out a Form 8300, and a photocopy of your last receipt. I'm going to need your ID, he says. You push back. I've never needed to give ID here before. I'm under $10,000. That's the law. He taps a new line on his computer screen. Not anymore, he says. The system is telling me you're over the limit for the year. If I don't file this, I get flagged. I'm not risking a $250,000 fine for anyone. You never wired money. You never wrote a big check. You never walked in with $10,001 in a single envelope. But an algorithm just decided you hit the line anyway. What changed? Let's walk through it. For years, stackers and small buyers relied on three beliefs. Stay under $10,000 cash in one shot, and you avoid Form 8300. Split your buys over different days, and you're clear. Small coin shops filing paper forms meant the data was slow, clumsy, and half lost in a filing cabinet. Those beliefs might have been practically true in the past. They are legally wrong now, and practically dangerous. The core of it is this. The IRS didn't have to lower the $10,000 limit. They just changed how every dollar under that limit is tracked. Starting as early as 2024 and fully biting in 2026, almost every serious precious metals dealer in the country is now required to e-file Form 8300. No more dusty paper forms sitting in a drawer. Digital forms lure searchable data. And once the data is searchable, the game changes. Because Form 8300 isn't just, did you hand over $10,001 today? It's also about related transactions. The law has always said, if you split one transaction into pieces to avoid reporting, that's structuring. Structuring is a felony, but in practice, that was hard to enforce when everything was on paper. Now, the 2026 interpretation and enforcement focus is on aggregation over a 12-month window. Here's how it plays out. You buy $3,000 in January, $4,000 in June, $3,500 in December. Same dealer, same ID, same pattern. In the old mind, you think, none of those is 10K. I'm fine. In the new system, the dealer's software sees same name, same address, same cash, same product. And it puts them in one bucket, related transactions in a single plan or series. That series adds up to $10,500. Under the clarified 2026 guidance, the dealer is expected to treat that as one customer, one plan to accumulate metal, and therefore, one reportable chunk over $10,000. This isn't theory. It's exactly what the IRS means when it talks about related transactions and single plan of purchase. The trap is simple. The more you think you're being clever by staying under the radar, the more you start to look exactly like the pattern the system is programmed to flag. But it goes deeper than just counting receipts. In 2026, the IRS and Treasury aren't just receiving dealer forms. They're running a data matching and alert system in the background. Here's the rough flow. Your dealer is now forced to e-file every Form 8300 electronically. Banks already send information on large cash deposits and suspicious activity. The Treasury systems cross-reference dealer cash deposits. Form 8300 e-filings time, amount, and sometimes even customer IDs. If a dealer deposits, say, $45,000 in cash, and there is no corresponding set of Form 8300 filings that explain where that cash came from, an internal light starts blinking. Result? The dealer, not just the customer, is at risk of an audit or enforcement action. Fines for noncompliance can run up to $250,000 per violation, plus potential criminal charges. So what do you think dealers do? They flip from being your friendly local coin shop to something much closer to a defensive agent of the reporting system. They start taking copies of IDs at $2,000, $3,000 just to have everything logged, using off-the-shelf KYC, Know Your Customer software designed for banks and fintechs. In some cases, recording vehicle plates in parking lots to tie faces to repeat visits, not because they want to, because they're scared. The government didn't have to touch the 10K number. They just made it so risky to miss a pattern that every serious dealer now front-loads the surveillance. Which means that cozy idea that you can do a few cash deals here, a few there, and the system won't know, is now directly at odds with how dealers have to operate to survive. And it's not just about buying anymore. Selling metal has its own reporting twist, Form 1099-B. Most people confuse 8300 and 1099-B. Form 8300 reports cash payments received by the business of $10,000 or more, including related transactions. It's about you spending. Form 1099-B reports proceeds from certain sales of commodities and collectibles. It's about you receiving. In early 2026, the IRS issued a significant correction to the instructions for Form 1099-B. The focus, aggregation of sales within 24 hours, and how some dealers had been playing the edges. Example, you sell 20 gold Krugerrands at 10 a.m. You come back the next day and sell 10 more. Total, 30 Krugerrands in 48 hours. Under the clarified rule, dealers must aggregate those sales if they're part of one overall liquidation, even if split over 2 days. For many bullion coins, the threshold quantity for 1099-B reporting might be, say, 25 coins in a 24-hour period, example of CFTC-linked thresholds. That means, day 1, 20 coins, below the threshold. No 1099-B yet. Day 2, 10 more. You've now crossed the threshold when aggregated. Dealer must file. You may think, I'll do half today, half tomorrow, and avoid a form. The system now interprets, same seller, same product, same dealer, same 48-hour window, this is one sale sliced in two. And the dealer, again fearing penalties, is going to report rather than risk. Now, here's a critical nuance most people miss. American Gold and Silver Eagles have special treatment. They are often exempt from 1099-B reporting, even in larger quantities, because of how the IRS classifies certain U.S. legal tender coins. But they are never exempt from Form 8300 when the transaction involves $10,000 or more in cash. So, you could potentially sell a large quantity of Eagles without triggering a 1099-B, but if the buyer hands you a suitcase with 10K plus in cash, the business receiving it still has to file an 8300. Two different forms, two different triggers, two different ways your anonymity can vanish if you misunderstand the rules. So where does privacy live in this new environment? Here's the part that feels backwards. Privacy is no longer in staying under the limit or gaming the system. In 2026, privacy lives in clean, legal structures, documented intent, and habits that don't look like you're trying to hide. Let's break that down. First, the temptation, structuring. Structuring is the act of breaking a large reportable transaction into smaller chunks to evade reporting. Legally, it's treated almost as seriously as money laundering. It doesn't matter if your money is 100% legitimate. If your pattern looks like you're trying to avoid a threshold, you can be charged. I just wanted privacy is not a defense. So if your plan is, I'll do 4K here, 4K there, 2K later, all in cash, nobody will know. You are literally describing the pattern that analytics tools are built to flag. Second, the safer move, wires and checks. It sounds wrong to people at first. Wire? That's a trail. A check leaves evidence. Here's the uncomfortable truth. The trail already exists. The question is whether that trail looks legal and straightforward or suspicious and chopped up. A clean wire for $15,000 to a reputable dealer with an invoice and a receipt is visible? Yes. Boring? Also yes. The system looks at that and says, customer bought metal, dealer received funds, dealer delivered product, all documented. 3 separate cash drops of $4,900 in a month at 3 different branches, followed by $4,800 in bullion buys at 3 dealers, looks different. Even if you feel more anonymous, the pattern invites scrutiny. Third, records are your armor. If you're serious about stacking in 2026, keep a dedicated binder or digital folder. Save invoices, receipts, wire confirmations. Note dates, amounts, and products. If you ever get questions about source of funds, about your buys or sells, about your pattern, being able to say, here's every transaction documented paid with legitimate money over these dates, is a world apart from, I have no records because I was trying to be invisible. In a digital-first enforcement world, transparency on your terms is better than mystery on theirs. So what should you actually do? Here's a practical framework. Decide what kind of privacy you really want. Is it, no one ever knows I bought any silver, ever? In 2026, that's almost impossible at scale, and chasing it can get you in real trouble. Or, I'm compliant, but I'm not volunteering more info than the law requires, and I control my own storage? If it's the second, now which is realistic, then your focus shifts to avoiding structuring, using wires ACH for larger amounts, keeping detailed records. Know when you're crossing a line. If you're approaching the $10,000 cash mark with a dealer over a year, expect ID requests, possible Form 8300 filings, and that there will be a record. Don't fight the dealer on this. They are not your enemy. They're someone trying not to get crushed by a system that can destroy their business. Be strategic about dealers and timing. Spreading purchases across multiple dealers isn't illegal. But if you're doing it specifically, and obviously to avoid any one dealer logging 10K, and you're leaving a weird footprint in your bank account, you're moving back towards structuring risk. Better, build honest relationships with 1 to 2 dealers. Be upfront that you may make several purchases over the year. Pay by wire when you know you'll cross big thresholds. Separate reporting risk from storage risk. Even if you navigate Form 8300 and 1099B perfectly, that doesn't solve bank bail-in risk, landlord-tenant vault clauses, or third-party insolvency. So, think about where you store, private vault plus home, plus maybe a small bank box with eyes wide open about contract terms, not illusions. Don't confuse "I didn't fill out a form" with "no one can ever touch this." The new reality of 2026 is simple and harsh. The government didn't need to lower the $10,000 number. It just wired the system so tightly that the old tricks for staying under it now look like signals, not shields. Privacy isn't in being unseen. It's in not looking like you're trying to disappear. The bars in your safe are your fortress, but your habits, how you buy, how you sell, how you document, are the gatekeeper. Don't let a misunderstanding of one form and one number undo years of smart saving. Do you think the $10,000 limit should be adjusted for inflation? Or is it being used as a tool for total financial visibility? Drop your thoughts in the comments. I read every one. If you want straight, no-hype breakdowns of how 2026 rules affect metals buyers, not just headlines, but actual mechanics, subscribe to RateScope. Stay informed, stay legal, stay in control.